You know, that's a relative question. If you'd asked the Japanese in '02 or '03, they would have told you tens of billions of dollars wasn't enough. I don't think it's the goal of the Swiss to make sure their currency actually, trades lower. I just think they want to take a little of the momentum out periodically.
Got it. Rick Santelli, thank you. Okay, quick look at the markets. The S&P hitting a 2010 high today. Commodities on fire, an 18-month high for oil. For more on today's market moves, let's head back down on the floor of the New York Stock Exchange, where we have Art Cashin, Director of Floor Operations at UBS. He is standing by with more. Art, let me ask you first the big question of the day. How do you set up for tomorrow's jobs number to trade that when you won't be able to trade tomorrow?
Well, I think what a lot of people have done is actually pare back on their positions. If you really want to make the play, you can electronically kind of tap in and hedge yourself in the bond market, and actually the mini S&P contract will be trading electronically. But what I'm hearing all around the floor is people paring back rather than trying to make a major bet on a highly volatile number and just slowing things down going into the extended Easter holiday. Remember, London will be closed on Monday too, so it's going to be a long weekend.
Oil breaking out today, busting to a new 18-month high. I know a lot of that has to do with the fact that this is the first day of a new quarter, so we're seeing a lot of money roll over and roll into this market. How is it impacting your market?
Well, the troika, as I call it, oil, gold, and stocks all moving in the same direction. In the last several months, I've told you that it's currency and volume, so it's the weakening of the dollar have aided all, and you very aptly point out it's the beginning of a new quarter. Historically, there's a bullish bias to the first 3 days of a new quarter in the stock market, barring some strange news, and everybody is starting to build up for that number tomorrow. It's like Christmas and Easter time. Everybody's looking for a big present, and we'll wait and see how it happens. But those three things, the weak dollar, the new quarter, and the hope for tomorrow, is what's got the market doing what it's doing.
Not that it matters, but we love round numbers. When do you think we get to 11,000?
Well, interestingly enough, we made a nominal new high today. For the viewers, it's 10,955, 58, somewhere in there. So if they can blow through 10,960, then 11,000 should be a chip shot.
Okay, Art Cashin, thanks so much. Have a fantastic weekend.
You too.
2 weeks until the April 15th tax deadline, and whether you've already filed your taxes or are waiting to get them in down to the wire, it's a good time to reassess the tax impact on your retirement savings strategy. CNBC Sharon Everson joins us now with a special guest. Sharon.
Well, Michelle, the tax bite into your retirement portfolio can come as a huge shock to investors. Joining me now is Lisa Feathergill, who is a CPA and a personal financial specialist. She's also chair of a special committee at the AICPA on PFS. And Lisa, of course, this is a big question a lot of folks have. Thank you for joining us from Winston-Salem. With the new health care legislation and the Medicare tax, what kind of tax fight are we talking about that investors might face?
Well, starting in 2013, individuals with income over $200,000 or married couples with income over $250,000 are going to have an extra 3.8% tax on investment income, meaning dividends, capital gains, and annuities. In addition, the capital gains rate is going back up in 2011 to 20%, and dividends will no longer be counted as a capital gains rate.
So then what do you do here? How do you lessen that after-tax bite?
Well, as CPA, personal financial specialists, we're really focused on the tax impact of investing, and that usually means focusing on after-tax returns. It's a lot of pre-planning to make sure that you're focusing on total return rather than income replacement.
Well, let's show people what the difference is. When you look at a portfolio, say you need $100,000 of income in retirement annually, and you look at what you would get from, say, an income-focused portfolio, what's the difference versus a total return portfolio?
It's huge. On an income-focused portfolio, which let's say is 50% fixed income, 50% large cap equities, the pre-tax return might be about 7%, but because half of the return is taxed at ordinary income tax rates, you're looking at an after-tax return of about 4.5%, whereas that total return portfolio, which is, let's say it's 70% equities, 25% fixed income, 5% cash, might have a pre-tax return of 8%, but after-tax 6.5%, so it's a huge jump.
So where do you put your money? Now you've decided how you're going to allocate it, but do you put it in your 401k, your IRA, a taxable account? What investment should go where?
For tax efficiency, it's nice to put your high-income investments like REITs and fixed income investments, as well as high-turnover mutual funds in the 401k where they won't be subject to income tax.
And for a Roth IRA or a Roth 401k, what are the things you should consider there?
Well, the Roth IRA is even better because you're not going to pay any income tax on the earnings in the future at all on the Roth.
Does that mean I should convert my IRA to a Roth this year?
Well, if you think the tax rates are going up and you think they'll be higher in retirement, and for a lot of retirees they are just as high in retirement as they are while working, it makes a lot of sense to go ahead and convert.
That might mean a lot of taxes, though, that I have to pay up front. Do I need to do that this year? And if so, why?
Well, the default is to pay the tax in 2011 and 12, but you have the option of paying in 2010. And I know this is counterintuitive, but the rates are going up in 2011. If you're in a 35% bracket in 2010, it's going to be a 39.6% bracket in 2011 and 12. It actually makes sense to pay the tax at the lower rate in 2010.
Certainly looks like it when you work out the math. Lisa Fethergill, thank you so much for joining us.
Thank
Back
you.
to you guys in the studio.
All right, thank you, Sharon. JP Morgan's Jamie Dimon is the face of Wall Street, and he's ripping politicians for demonizing bankers. We're going to tell you what he said in his Warren Buffett-like letter to shareholders.
But is Dimon right or not? Is there too much Wall Street and specifically bank bashing going on, or do bankers and traders deserve the beating they've been getting? Tackle it, both sides. Other side of the break.
New Retirement is sponsored by Ameriprise Financial, our advisors to your dreams. More within reach. Meet us today at Ameriprise.com.
I have clients say it's really hard to save for the future, and they've come to a point where it's overwhelming.
Oh, gee, I'm scared to tell you I've got this amount of credit card debt, or I've got a 15-year-old, and we never got around to saving for their college.
That's when I go to work.
We talk, we start planning.
We can fix this. I know when clients walk out of my office, they feel confident about their retirement.
Visit Ameriprise.com and put a confident retirement more within reach.
At Northern Trust, we understand that while you may come from the same family,
You know, son, you should take up something more strenuous.
you have different needs and desires.
I'm reading a book. What's a book?
So we tailor plans for individuals, featuring a range of integrated solutions.
Your usual restaurant? Indeed. See you tomorrow. Stairs? Elevator.
To see how our multifaceted approach can benefit your multi-generational wealth, look ahead with us at northerntrust.com.
What had happened in Central Harlem was failure became the norm. The schools were lousy, the healthcare was lousy, gangs were prevalent, violence was all over, families were falling apart. You can't raise children in a community like that. People had to think about things, but not do it. I'm doing great. How about right here on 119th Street? If we could fix this block, then we could fix the next block, then we could fix the next block. We promise parents, if your child stays with us, I guarantee you that child is going to graduate from college. Failure is simply not an option. 60 to 70 to 80 to 97 blocks, which ends up being 10,000 children. We start with children from birth and stay with those children until they graduate. If you really want to have an impact, get there going one step at a time. There is no act that is too small to make a difference.
No matter what you want to do, Members Project from American Express can help you take the first step. Vote, volunteer, or donate at takepart.com. A tale of unbridled greed and arrogance. The inside story of history's greatest business scandal. Enron, the smartest guys. Tonight, 9 Eastern on CNBC.
JP Morgan Chase Chief Jamie Dimon speaking out against big bank backlash in Washington, defending the bank's roles in the economy. Our Mary Thompson joins us with more on Mr. Dimon's strong words. He has become a kind of almost Buffett in these annual letters.
He's been doing these, ever since he took over Bank One, and it's something that he evidently spends a lot of time on, at least 20 hours or so, I'm told. Of course, his strong words were found in his annual letter to JP Morgan shareholders. We've heard Dimon speak over the last year and a half. These words have a familiar ring to them. In the 36-page missive, he says his bank and other healthy ones shouldn't be lumped in with unhealthy institutions. And while it's tempting to identify a scapegoat, it's pretty obvious no one was solely to blame for the financial crisis, while no one should be completely absolved from the blame. Referring to big banks like his, Dimon writes, in the current political environment, size has been demonized, but that capping the size of America's largest banks won't change the needs of big business.